Hello, everyone. This is Ted Bauman here, editor of Bauman Daily, of Bauman Letter, and of Profit Switch. Wearing a cricket shirt today. That's my theme. It's because there's a big test match series going on in England at the moment between England and New Zealand, which is fundamentally the World Test Championship because they're the two highest rated countries in the world. Gee, it thrills me. I know there's a lot of you out there who are cricket fans, and this is a good time to be watching two excellent teams. My money's on the Black Caps, my second favorite team after my team, the South African Proteas, who are currently playing in the West Indies. Sadly, I couldn't go down to see them because they're not letting people into the stadiums, because thanks to COVID. Today, I want to talk about the relationship between politics, if you like, and the market. And I think this is an important thing to revisit because my thesis is that right now we're in a situation where everything on the thing that is driving the key sectors of the stock market, particularly renewable energy, electric vehicles, infrastructure-related stocks, it all depends on things that are happening in Washington. It's not about companies' earnings. It's not about short-term trading indicators. And it's important to understand that because for investors who take a very short-term view of the market, they may wonder what's happening with stocks. I've had people write into me and say, how come stocks that you said you thought were going to do well haven't done well? Well, it's because of continuing uncertainty on Capitol Hill especially. So let's explore this by looking at a couple of different ETFs. The first one we're going to look at is the Solar Invesco ETF TAN, that holds all the big solar renewable related stocks. Now, this particular ETF traded more or less in a band between $20 and $40 for most of the period in the run up to 2020. It started to run up pretty significantly just before the COVID drop, and then it fell like everything else. Now, I just want to point out one thing about this big drop in this stock at that point, and that is that like all other stocks, this stock fell because the Federal Reserve Chairman, Jay Powell, announced unexpectedly one day that the Federal Reserve was going to cut interest rates dramatically and start buying up Treasury bonds and other even corporate debt to support the economy through the COVID crisis. And that was the point. That's actually what caused that big decline, because people realized, hey, this is a bigger deal than we thought if the Fed's going to do this. That's what caused the market to collapse. It was Jay Powell. Now, of course, there were real reasons to fear what was going on, but then look what happened. We all know, along with the rest of the stock market, these stocks rose dramatically over the rest of 2020 and into 2021. And that, again, is thanks to the Fed's interventions to keep interest rates low and also to keep pumping liquidity into the markets. That, in turn, convinced people to buy stocks with earnings far in the future, because with low interest rates, you can expect the value of that future money to be just as high as it is today. But what I've done here is to take three vertical lines that indicate three events that were associated with big spikes. Two of them with big spikes and one with a big drop in the value of this ETF. I'm going to use it to illustrate my thesis. So the first one was on the 28th of September last year. And there was a big jump in the ETF. It rose from about $60 level up to over $75 in the space of a couple of days. And the reason for that was, I believe, that I went to the New York Times and looked at their headline for that day. And it was the day that there was a leak of former President Trump's tax returns that showed that he hadn't paid taxes for many, many years, and that, in fact, that the most recent tax payment was only $750. And I think at that point, the market realized this guy's toast. He's not going to beat Biden. There's a hardcore of supporters behind him, but this makes him look not like a man of the people as he says he is. And I believe that whether that's true or not, that a lot of institutional traders thought, let's buy renewable stocks because President Biden would be very favorable towards them. So that was the first big jump. The second one came in the middle of December, specifically the 14th. What happened on that day? New York Times headline says, well, the first vaccines were being administered that day. But another big thing happened. The Electoral College voted and they chose President Biden as the victor. Of course, there was further contestation that led to the issues in January at the Capitol. But fundamentally, at that point, the market said, okay, This is even more confirmation, if we needed it, that Biden's going to be in here. We're likely to see a lot of government support for renewables. Let's buy the stock. So it kept going up, but then it fell. And I pegged, when I looked at what happened on the day that it fell, and it was a big drop. It fell nearly 20% actually on that particular day. What happened? President Trump, or ex-President Trump, was acquitted of the accusations that led to his second impeachment. Now, why would that lead to a fall? I believe that what happened was that the market realized that if the Republicans couldn't bring themselves to support impeachment after everything that they had said after the events of January 6th at the Capitol, all the things that said how horrible it was, and even Mitch McConnell standing up and saying, he blamed Trump for this. If they couldn't bring themselves to vote for impeachment, then it was highly unlikely that they were going to cooperate with Biden's most expansive proposals. And so as a result, I think they sold off the stock. They read the tea leaves. They saw that the Republicans were not going to play ball. And that meant that, particularly since the Democrats only held a very small, the thinnest possible margin in the Senate, things were not going to be as great as everybody thought. And after that, TAN has really basically pulled back. It started to stabilize a bit, but fundamentally, all that hype evaporated. Now, the key thing here is that, as I've shown, you can track the movements in those big movements, those three big movements, directly to political events and how people took that headline news and translated it into trading. And that just goes to show you that if you're an investor who, has got a big thing for, let's say, renewable stocks, I believe I do, then you're going to have to take this with this is part of it, that you're going to deal with these big ups and downs based on politics. But of course, if an infrastructure bill does pass, which I'll talk about in a moment, we could see another big jump in TAN. And that's the critical thing. You position yourself for that big jump. You don't wait until it happens. And at this point, it's anybody's guess, but I'll come back to that in a minute. Now let's look at another ETF. This is the Dynamic Building and Construction ETF, PKB. It covers essentially the kinds of companies that are involved in supporting any kind of big infrastructure push, things like building highways, rebuilding bridges, all that sort of stuff. Had a pretty good run from the beginning of this year. This chart goes back to the beginning of the year. And then on the 10th of May, it tanked, and it's fallen even further since then, but essentially it's in a consolidation or wait and see pattern. Now, why is that? Well, New York Times said on that day, that was when the April jobs report came out, and everybody was shocked that growth in employment had been so small. Here's what I think happened. The market looked at that, thought, okay, the economy is not growing as fast as everybody thought it would. That means that the Democrats are probably going to push for further stimulus spending. That, in turn, will probably make it more difficult to pass an infrastructure bill because they'll have to put more money into people's pockets to compensate. That's the first thing. Second thing is that all that money flowing out to try to keep the economy in recovery mode is going to lead to inflation. That will lead to higher interest rates. And that will mean that we are less likely to see a big spending on infrastructure because the government would have to borrow at those higher rates. So fundamentally, again, you can see that even though it wasn't directly related to infrastructure, the bad jobs report had a very negative impact on this particular ETF and the stocks, obviously, that are part of it. Another case of where people anticipate what government is likely to do in response to a particular economic number, and that becomes the basis of what happens to that ETF. Here's the third one, the famous ARK Innovation ETF, ARKK, which holds all kinds of stocks that are considered by Cathy Woods, the purveyor of that ETF, to be the future. Companies like Tesla and so on, companies that have the big growth potential, often not profitable now, but far in the future they will be, she believes. I've laid over that the 10-year Treasury yield in blue. Now here's the story that this tells. Interest rates began to tick up from late last year. It was starting in August. They rose gradually, but by the beginning of January, they were still under 1%, which is an incredibly low figure historically. But then in the first box that I signaled there or have circled, you see that they took two jumps up, on specific weeks. They rose to 1.1 from 0.9% to 1.1% yield, and then again on the 16th of February they rose to over 1.2%. And a lot of people had said 1.2% was a critical point. If it rises above that, that's going to have a negative impact on the high-flying growth stocks. And boom, look at that. On that day, the day that interest rate broke 1.2%, ARK collapsed. And why did it collapse? Because people know that the future earnings of companies, growth companies that do not currently earn a profit, are discounted more heavily if you have higher inflation and if you have higher interest rate yields, because that means that the value of future money is less than the value of present money, which is something that I talk about a lot in the Bauman Letter and in Bauman Daily. In fact, we have acquired a couple of companies that earn good cash flows and good dividend yields right now, because the market is expressing a preference for current earnings over future earnings. That's the strategy. All right, but then look what happens after that. The interest rate continues to rise. ARK trades sideways for a couple of weeks, and then it falls again as interest rates began to rise again in May. But then really probably about a week before I signaled it, you saw that interest rates began to fall again, and just like clockwork, ARK begins to rise. It's rising. It's probably forming a little mini cup and handle formation, they call that, on the far right-hand side there, which could lead to a further breakout in ARK. But the key thing is to look just above that second rectangle and look at the blue line pointing downwards. That is the fall in yields that's going on. So they have three examples of how public policy and anticipations of the responses to public policy play such a critical role in the fortunes of your investments, particularly if you invest in stocks that you expect to earn money in the future, right? This is the critical message here. Renewable stocks are utterly dependent on what the government does in terms of supporting renewable energy as part of an infrastructure program and through government policy. Infrastructure spending depends on the ability to get a sufficient number of votes in the Senate to pass a bill, either with Republican support or through what they call reconciliation. Both of those are extremely uncertain at this point, and that is why we've seen a pullback in the prices of companies related to that. I get people writing into me all the time saying, hey, you picked a bad stock because it went up and then it went down again. Well, I stock pick for a living, but there are limits to what you can do in an environment where the government is actually driving the performance of a lot of the companies. Yes, there are companies out there whose stock prices are rising, and particularly in the pharmaceutical sector and other various technology sectors, because they're small, they're very illiquid, but somebody has spotted them and their prices are beginning to rise. But for the vast majority of companies that are really the future of the economy and of the stock market, right now there's a lot of sideways trading going on because people are uncertain about what's going to happen in Washington, D.C. They're uncertain about how the Fed is going to respond. Now, what are my predictions? My first prediction is that I don't think the Fed is going to raise interest rates this year. I think that they are correct, that because of the very, very low the low price levels that we saw in March, April, and May last year, when companies were cutting their prices to the bone to try to maintain cash flow in the face of COVID. Now, of course, they're raising their prices because they can, because they need the cash flow, and 3, because there's big demand for goods, and 4, because there is actually a shortage of a lot of inputs. But all that's going to fade, I believe. I buy that argument that this is transitory. I could be wrong, but I still don't see the underlying drivers of long-term inflation. And one of the big ones, of course, is that we don't have unions anymore that can negotiate higher wage rises. So what about Capitol Hill? That's my second prediction. I predict that we probably will get an infrastructure bill, but I think it may exclude a lot of the renewable energy stuff that a lot of people are so keen on. I can't be 100% sure on that because it all depends on what happens to a guy from West Virginia named Joe Manchin, who is effectively co-president with Joe Biden right now, who has a veto over any major policy exercise in Washington, D.C., because he is the deciding vote. Now, what that means is that we're going to have to adopt a wait-and-see attitude. But look at it this way. If it looks like there's going to be a positive move, if maybe they're going to use the reconciliation method to pass an infrastructure bill that includes renewable energy stuff, then I think you're going to see a big pop in these stock prices on the order of 10, 20, or 10, 15, 20%, even on a single day's trading session. How do you know that's going to come? You don't, but you got to read the tea leaves coming out of Washington. That's what I do every single day with these stocks. That's what's driving the stock market right now, I believe, more than anything else. Anyway, that's all for me today. The lesson is, I think, you got to read the headlines, maybe even if it's boring politics stuff, to see what is likely to be going on. Dig in deeper, look to see what the big boys, particularly Joe Manchin, are planning, because that could determine where your stock prices go. Key thing is you want to buy them before they pop. Anyway, this is Ted Bauman signing off. I'll talk to you again next week.